Hi there, it's Azilia here from Tax World. Today I'd like to talk to you about Section 110 of the Taxes Consolidation Act 1997. Section 110 discusses the special tax rules for securitization transactions, which are financial transactions conducted by a securitization company. Securitization is essentially a process where a company, usually created for this specific purpose, buys a pool of loans from a bank. This company collects repayments, handles changes in interest rates, and may take legal action if necessary. Typically, the company's income is the difference between the interest it collects from the loans and the interest it pays on its own borrowings. A securitization company must meet certain conditions to qualify for this special treatment. It must be resident in the state. It acquires or manages qualifying assets or enters into contracts involving qualifying assets. Its business involves holding or managing qualifying assets. It doesn't engage in any other activities except those related to managing qualifying assets. Its assets under management are worth at least 10 million euros. It must inform the revenue authorities that it meets the above conditions using the appropriate form. Qualifying assets can include shares, bonds, debt instruments, leases, futures, options, invoices and receivables, greenhouse gas emissions allowances, insurance contracts, and more. Profits from securitization are generally taxed under Case 3 but are calculated using Case 1 rules. Securitization companies can deduct bad debts that cannot be recovered, while recovered bad debts are treated as income. Securitization companies are not allowed to transfer a loss for corporate tax purposes. However, they can carry forward unused losses to offset against future profits. Interest payments might sometimes be seen as a distribution for tax purposes, which means they are not tax deductible for the payer. This section sometimes reverses that treatment, treating the payment as tax-deductible interest. However, there are exceptions to this rule, especially when the interest is dependent on the company's performance, or if the payment isn't made for genuine commercial reasons and is part of a tax avoidance scheme. Finally, control over a securitization company is defined as having the power to secure that the company's affairs are conducted according to someone's wishes or having significant influence over the company, along with holding more than 20% of the company's issued share capital or certain securities. I hope you found that useful, and I'll see you in the next video.